You don't win a bull market when you buy, you win when you sell. Most investors ride the wave up, feel invincible, and then give it all back when liquidity thins and volatility spikes. This guide hands you a practical, rules-based exit blueprint so you finish this cycle with more money than you started with. You'll learn when to stop adding risk, how to scale out methodically, and when to fully exit, even if the market is still screaming higher. The edge isn't about calling the exact top, it's about converting paper gains into durable, real-world outcomes before the crowd panics. Start with purpose, not prices. Write down the life outcomes your gains are meant to fund: mortgage payoff, education, business runway, emergency buffer, and translate them into after-tax dollar targets. Reverse engineer those numbers into portfolio values so you know, in advance, the equity curve that equals mission accomplished. When your plan says you're funded, even if it happens earlier than expected, you have permission to declare victory. Most people never do this. They wait for one more pump, then watch profits evaporate. Putting numbers on your why turns a vague hope into a hard trigger that future you will thank you for. Now build a sell framework you can follow under stress. Think in tranches rather than all-in, all-out swings. A simple model is to trim 10 to 20% of a position every time it advances another 10 to 20% from a prior checkpoint, tightening the interval as sentiment turns euphoric. Pair price-based trims with a time-based release, monthly or quarterly, to make sure you are consistently converting gains even if the chart doesn't give you a perfect setup. In late cycle, front-load trims in small and illiquid altcoins because when liquidity disappears, it disappears there first. Use limit orders to control slippage in thin books and keep a written ledger of executed tranches so you don't forget to sell when things get exciting. Your signal stack should be short, reliable, and acted on quickly. Funding rates that stay elevated for days on majors and hot narratives tell you prices are being supported by borrowed money. When the cost to go long is rich across the board, the market is fragile and one shock can cascade through forced liquidations. Crowd heat indicators. Fear and greed readings sustained in the 80 to 95 zone. Google Trends breaking to multi-year highs on Bitcoin and the current meme coins. Exchange app downloads spiking. YouTube view surges on broad crypto as back content confirm that latecomers are piling in. Market structure cues matter as well. Open interest climbing faster than spot, perpetual futures premiums expanding, RSI and breadth printing cycle extremes, and a blow-off phase where low-quality coins rally after high-quality ones stall. You don't need every light to go red. 2 or 3 together is your cue to accelerate distribution. Treat altseason as a distribution window, not a permission slip to YOLO. When BTC dominance stalls and alt-BTC pairs go parabolic, you will see days where mid and small caps print plus 40% to plus 80% moves. That is not the moment to increase risk, it's the moment to warehouse gains. Rotate the froth into safer layers. Convert portions of alt wins into BTC, ETH, then into stables or fiat depending on your cash flow needs. If a narrative coin doubles in a week, sell into strength, and if it doubles again, sell again. The market will tempt you with one more squeeze. Your plan should assume that squeeze is your exit. Get specific about liquidity, custody, and counterparty risk while you're selling. Realize profits to a layered stack. Some fiat for near-term obligations, some stablecoins spread across reputable venues, and cold storage for anything you deliberately intend to hold through a bear market. Avoid adding fresh leverage late in the cycle. If you insist on staying partially exposed, reduce notional risk and consider hedging instead. Small, defined risk options or futures hedges sized to cushion a sharp drawdown. Reconcile that taxes and fees are part of your true P&L. Plan lot selection, capital gains timing, and jurisdiction rules before you press sell so you don't donate avoidable basis points to slippage, spreads, and the tax man. Expect the macro to mislead you at the finish line. Rate cut headlines, record highs in risk assets, and at this time it's different drumbeat or features of late cycle tapes. Final tops often form as a violent melt-up followed by an air pocket where bids vanish. Don't anchor to narratives, anchor to your rules. If your target is hit in November but your favorite influencer swears the real run starts in January, exit anyway. Tops are events, not destinations you can schedule. Your playbook must be ready for both a grind-up and a face-ripping spike. Different coins deserve different exits. Bitcoin and ETH can be trimmed more patiently because liquidity is deeper and reflexivity is lower. Illiquid, high FDV tokens with large unlock schedules or weak real demand should be de-risked sooner because supply overhangs crush late sellers. Watch tokenomics in plain English. High emissions, upcoming cliff unlocks, or recent exchange listings that juiced price without on-chain usage are all signals that your best exit is before the calendar event. If your thesis was a catalyst and the catalyst has played out, your default should be to harvest, not to hope for a sequel. Build an, in case of euphoria, subplan. Decide today what you will do if your portfolio jumps 30 to 50% in a week. Pre-write the instruction. If total equity greater than $X, move Y% to cash and Y% to BTC, ETH, then stop buying. Euphoria is when people abandon plans and chase green candles. Pre-committing to actions that feel conservative in that moment is how you convert a windfall into a win. Similarly, write a drawdown rule. If the market drops 15 to 20% from the last local high while funding remains positive and social heat is still extreme, that's your sign to finish remaining trims because the distribution top likely printed already. Cash management after exiting is part of winning. Funnel realized gains into boring, freedom-creating goals. Paying down debt, building a one-year runway, seeding a conservative portfolio, or funding skill building that increases your future earning power. If you insist on maintaining exposure for the next cycle, ring-fence a small, predefined evergreen stack, for example, 10 to 20% of your crypto allocation split between BTC and ETH that you won't touch even if the market retraces 60 to 80%. That keeps you psychologically satisfied while protecting the bulk of your gains from round tripping. Document everything. Put your targets, tranche sizes, signal thresholds, custody steps, and tax notes in a one-page rule sheet you can read in 60 seconds. Save a simple execution log. Date, asset, percentage trim, reason funding elevated plus fear and greed 88 plus app downloads surge, destination wallet, and next checkpoint. In the heat of FOMO, you won't remember what you meant. In a cascade, you won't execute cleanly unless the instructions are visible and boring. Here's how the full arc feels in real time. Mid-cycle, you stop buying breakouts and only add on clean pullbacks in the highest conviction names, if at all. As sentiment climbs into persistent greed, you begin trimming majors and rotate speculative wins into safety. When funding, views, and search mania go vertical together, you accelerate distribution regardless of how strong the feed looks. If a final melt up arrives, you finish your tranches during that frenzy, keep only the evergreen stack you committed to, and step aside. You don't chase the first dip after a top. You let liquidity reset and your future self enjoy the calm. None of this is financial advice, and you're responsible for your own decisions. But the pattern is timeless. Bull markets make you money. Exit plans let you keep it. Write your rules today, execute them when the lights flash, and trade the future anxiety of what if it keeps going for the present certainty of a life you actually wanted your gains to fund.